Hi, Dominique, and welcome to another edition of The Week Ahead. How are you doing?
Very well, Andrew. I still see the beautiful pine trees in your background. How are you doing?
I'm doing good. We
Is
played,
London?
yes, it's actually nice in London. We played golf, Alexander and I, with a friend and his dad. Very nice. And the market seemed to be pretty happy these days as well. I was just looking through Bloomberg just over the past week. Most of the global equities were up kind of 2 to 3%. And I saw NASDAQ, I guess, finished the first 6 months in kind of the best performance in, I don't know, 40 years, which doesn't feel like many people kind of call that. Although I remember in February, you were saying you really could see the kind of next 3 to 6 months being positive for markets, because mainly people were very worried about growth, which you weren't. And obviously that's played out well.
Strong growth, stable inflation, what's not to like? And this could last for some time.
Yeah. And that's Friday as a perfect example. So on that, let's segue into everything that happened over the past week. What were your big takeaways? Anything seemed surprising or, didn't fit the pieces in the puzzle?
So let's start with the Fed, shall we? So poor Chair Powell had to face another barrage of questions about his so-called hawkish pose. And this time around from fellow central bankers and also from hard-hitting news anchors. This was at the ECB conference and the Bank of Spain conference. And he explains that the pause was justified because he sees rates as having been restrictive only for the past 6 to 9 months, which seems to be based more or less on a break-even, on a real rate turning positive. And so he thinks the full impact of this restrictiveness has yet to be played out. He doesn't know how long it will take, and so on and so forth. But the bottom line, I think, is no news. Likely to have a hike in July, a hike in November. Chair Powell said 2 consecutive hikes were not out of the question, but I think what Chair Powell is doing now is basically what Mark Carney was doing when he was BOE governor, which is to create artificial uncertainty around the central bank decision. I wouldn't take it at face value. I stick to my forecast.
Yep.
What would be needed to change that forecast is an inflation shock. And by definition, shocks are not predictable. So I don't think we learned a lot. I think what's perhaps interesting in terms of the Fed outlook could be an acceleration of growth. So for the past 9 months, the Fed has been saying growth is slowing, and guess what? Growth is not slowing. So the question next is, will growth accelerate? Not my base case scenario.
Right.
I'm looking at indicators like employment growth or real income growth, real household income growth. And employment growth has stopped slowing, and household real income growth is accelerating. And by the way, I don't think the striking down by the Supreme Court of the student debt forgiveness is going to make much of a difference.
I wouldn't think so, right?
No, because we're talking about 400 billion of debt forgiveness against 20 trillion of total household debt and 150 trillion of household net worth. So a drop in the bucket by a very mysterious happenstance. This 400 billion happened to be concentrated on the Democratic constituents, I mean, college kids, and most importantly, colleges themselves, because who is benefiting from this, easy lending? It's colleges. That's what's been driving the cost of college for the past 30 years. So that's good for those people, but the rest of the economy, or rather the Supreme Court decision is bad for those
Bad for
people.
them, yeah.
But for the rest of us, not that important.
Right.
So the
And
Fed,
sorry, one question
yeah.
on real rates. Like a year or a year and a half ago, where did you think real rates would have to get to be restrictive enough? And is that number actually higher now than even what you were thinking a year ago?
Definitely, but I have to confess to something, and I actually don't think tips have a great degree of relevance to the economy.
Yeah.
Also, when we talk about real rates, we usually use a forward-looking measure of inflation. And whether we use survey or break-even, those measures tend to completely miss turning points. So this time around, as Mustafa keeps telling us, the gap between the survey and the break-even expectation of inflation is the widest it's been, I think, more or less since tips were introduced. So it could be that surveys are, because in my view, we are moving towards a higher inflation environment. So it could be that break-even are kind of lagging surveys, and that's why we have such large real rates. Basically, markets have a very strong faith in the Fed ability to keep inflation under control, possibly because the alternative would be really dreadful, and people don't like to think dreadful.
Right.
But in terms of the real economy, seriously, I think what matters what matters is more the where we are relative to the Taylor rule. I mean, because basically when you talk about real rate, you look at the Taylor rule with just an inflation component, not the unemployment component. So I prefer using the Taylor rule as a benchmark.
Right.
I was more optimistic about the Fed willingness to do the right thing to contain inflation. So certainly real rates are not my expectation of real rates, even using the survey data on the expectation of inflation. I know I didn't think real rates would be as low as they are using the survey data. I thought the Fed would get closer and faster to the Taylor rule. So,
Right.
and that I was wrong. Those guys basically have no appetite to bring down inflation because it's going to be really painful.
Right. Or they just thought inflation was going to come down
Yeah.
easier with what they've, well, yeah. Anyway, either way, I guess the result is, oh, so you think it's possible that they are okay with some inflation at this point?
Oh, definitely. If you look at their projections of unemployment and inflation, especially the projection for the end of this year, it's been steadily going up, which means, basically right now they are projecting end of year inflation nearly 4%, so twice as high as their target, while end of year unemployment is still below 4%. So basically, I mean, their projection is basically what they are prepared. I mean, what they are trying to engineer for the economy, right? Because we have to assume that they believe they have some degree of influence over the economy. So when they tell you that they project inflation at 4%, this is basically what they are prepared to accommodate with their policies. I mean, that's basically what the SCP is telling you. And no judgment on my part, but I just look at this data and it's clear that they are much, much more focused on the employment side of the month.
I'm sure there's a little bit of the idea that, like we've discussed, and also Mustafa's pointing out, like when all those cuts were priced in, not everyone was assuming they were going to start cutting. Some people maybe, but really it was a set of path-dependent possibilities, and one of them being they'd have to cut like 300 because there was some massive issue, although we disagreed with that. And now that's gotten priced out. It's yeah, so the market can change its mind, by the way. You know, it went from all those cuts, we've been talking about it. We always thought that was an interesting trade, and now all that's gotten priced, pretty much all priced out. I still, for me, I think you guys don't agree as much. I still find it strange why the longer end of the curve is so low, and there's such an inversion in that sense, especially if it looks like the Fed's it would be willing to accept higher rates for much longer, or it just we're just structurally in a higher inflation environment for maybe the next 5 to 10 years for many reasons that we've discussed in the past.
Or the Fed will have to tighten by more than in previous cycles because of all the things we discussed, the fixed rate 30-year mortgages, the super high wealth inflation, basically the inflation of asset prices, 20 years of asset price inflation from the Fed. So they will have to tighten. Actually, we may have to go even above the Taylor rule, and the consequences will be more devastating than in previous tightening cycle, hopefully with the exception.
Hence the deep inversion.
Yeah.
Just getting even wider, even if back in years go. Okay, cool. Anything during the week that, thank you, that was great. I hope everyone enjoyed our discussion there. Anything else specific of this past week? Yeah.
The bad times will not come right away. Okay, I think we'll have a good summer. I see much more upside to equities prices. So lots of good time ahead, but sadly, this may well have to be paid for later on.
One question before we go to the week ahead. Friday's price action. In general, those seem like pretty positive numbers. Growth was okay, and inflation was in line or a little softer. Was there do you agree with the market's reaction or no?
So growth is good. Inflation is not as accelerating. Underlying inflation trends are not softening either. So, I mean, in my view, it's like a Goldilocks. I mean, high growth, stable inflation, Fed not being aggressive at all, markets with strong faith in the Fed. I mean, this is good for equity. This is good for risk.
Yeah.
This is good to last.
Okay. Okay. And then the week ahead, I know in the US, certainly Monday and Tuesday should be pretty quiet. So yeah, what are the things to look out for in the upcoming week that investors should be thinking about?
So it's NFP week, and I think once more we are going to have a positive surprise. I think the consensus is about 200K from above 300. What can I say? I've been saying, I don't know how many times, maybe every month since the beginning of the year, I've been saying there will be a positive surprise on NFP. And if you look at the GDP data, it's the same. There is a systematic negative bias, consensus bias. And I mean, you can look at it around the GDP releases, but also look at the Atlanta Fed GDP, which has been, so their nowcast has been systematically underpredicted by the consensus. So I think it's another one of those. Maybe the markets will have a little bit of trepidation, you know, an increase in heart rate on the day because, you know, of the positive surprise. But it will pass because it's not going to impact the Fed. So that's my expectation for the NFP.
So one question on NFP. My understanding is that part of the reason the numbers are still pretty high or even higher than expected each month is because the US is still refilling some of the service sectors jobs that were lost over the last 2 or 3 years. Is that, you know, like retail, food and beverage and like, have all those jobs been added now, or is there still?
They are still being refilled. And what's interesting is that it's impacting hours worked as well, because a decline in hours worked has been, pointed out as an indicator of growth slowdown. But if you break it down between supervisory jobs and non-supervisory jobs, you see clearly that hours worked for non-supervisory job is what for supervisory job, so for skilled job, basically what's going on is that jobs where people have to interact with other human beings, that's those where companies are struggling to fill. So if you look at supervisory hours, yeah, they are falling, but it's because supervisory employment as a share of total employment is still above pre-pandemic. So companies are still trying to bring back people in the low-skill jobs. That's why low-skilled workers have tended to get paid more than high-skilled workers, and their hours worked are still above where they were before the pandemic. So sure, I mean, it's partly a catch-up. You also have, I think, a structural adjustment. I mean, if you look at investment in software, it's amazing. I mean, it's just up, 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 up. And clearly there is an attempt to substitute software to people. Like, for instance, I was looking for a house in LA, and many real estate agents actually don't show up to show you the house. They have a system where you call in, you give a code. With the code, you open a box and you visit the house. So it's one example of many of how businesses are coping with the shortage of work. And the thing is, if you look at participation of prime age workers, so people between 25 and 55, it's actually higher than before the pandemic. It's a participation of older workers that's below and not because those people have gone to retire. So firms are really struggling to bring back these workers, and that's why, in my view, if growth continues to be as sustained as it is now, or even if it accelerates, we're going to see wage
growth.
Yeah, faster wage growth.
Okay, awesome. Any specific data events or anything?
So besides
NFP.
The NFP, so we'll get the PMIs since it's the first week of the month. But again, manufacturing is only 10% of the economy. The services PMI is divorced from the hard data. So these are in the Bloomberg calendar. I'll be commenting on those on chat, but I'm not expecting much interesting news there. We're going to get the JOLTS, but again, it's a day before the NFP. So, and the JOLTS is a lagged month. So not much news here. Most interesting possibly is going to be the construction spending. And there it's easy. We're going to see a continued uptrend in non-residential construction. Basically, there are a number of chips factories being built in the US. The administration has given huge incentive. In fact, the Treasury Department had a detailed review of the data. So we have this amazing pickup in foundries construction, which, by the way, may well end up, with an oversupply of chips a couple of years down the road. But
I'm sure.
No need to worry about a couple of years down the road. Let's enjoy the party while it's still going. And also residential construction, it's amazing. It's already recovering. So it's going to show that residential construction is bottoming up, and based on the housing starts that we got a couple of weeks ago, it's clear that residential investment in this quarter's GDP is going to be positive. So what can I say? Happy days, despite the lack of debt forgiveness for the 400 million Americans who could have benefited from it. I think they will do very well still.
Okay, awesome. As we always like to do, we'll kind of end with some highlights from publications this past week. So if I look through some of the interesting kind of pro-wealth articles, on the pro side, Henry's PCA model looking at interest rate curves, now adding even more countries globally. And there, I was just looking through it. The positive hit ratio on trades recommended is 74% for the year, which is just amazing. Definitely worth checking that out. Right now, it's recommending 2 interesting curve trades in Europe and Japan. The Varesh put out the oil weekly. So that's kind of looking at at this point, oil prices just not high enough with where costs are to really make an attractive ROI, especially in the US, to invest in new opportunities in new fields, unless there's a very high level of kind of expected success. So those kind of things, and there can be a 6 months to kind of 2 or 3 years lag on these types of investment, especially bigger infrastructure. And so we just over time that should be supportive for the price of oil, as it's just not encouraging a lot of new investment. And that's been something which a lot of people in energy have been worried about, and that looks like it's really playing out. China growth tracker. So we look at a few different aspects of analyzing Chinese growth independently, which has had a fantastic track record. So when I look at, or when we look at the more high frequency data, it's actually starting to turn up for the first time in a long time. So I don't think it's signaling a huge change, but it looks like some support for potential Chinese growth in the coming weeks and months. And then last thing I would say is we're looking through, a lot of clients ask us about more insights and our thoughts, and follow pretty actively our work we do around looking at many different aspects of understanding FX carry. Eventually we'll be releasing carry strategy analytics for more than just FX, but right now primarily it's in FX and EMFX. And those strategies have done very well this year, particularly carry with an overlay of equity performance. And, it's also interesting to know which currencies go in and out of positive carry strategies. And over the past over the past week, well, some of the carry strategies in EM have struggled because of the big Turkey depreciation. Obviously, that's not there in the equity. But for several of the strategies, also for vol reasons, Turkey did get replaced. And on the short side, which is interesting, is that CNH is replacing Korea on the short side. So there has been increasing pressure or interest in understanding why CNH is so weak. That could be another reason. Obviously, there's also the potential of currency devaluation kind of stress for China versus what's happening in Japan. And that's also something obviously investors should be looking out for. That's kind of it from my side. I don't know if you have any parting words or thoughts for this upcoming week.
Just to wish all our American listeners a very enjoyable 4th of July. And just to say that we should all look forward towards, very prosperous and hopefully quiet summer. At least that's what it looks like from.
It looks like it's heading down that path, yes. And Yes, and happy July 4th to you, your family, and to everyone listening. We will be supporting it even here in London. So
Excellent.
okay, cool. Goodbye. Enjoy the weekend, everyone. Goodbye.